Coinbase once said that it had, quote, no plans to launch a token for Base, its Ethereum Layer 2. Now, Base's creator confirmed it's, quote, exploring one. That's exciting, but there's an elephant in the room. Coinbase already has publicly traded stock. With this new announcement, there are so many questions. Who will get the Base token airdrop? Will the drop be lucrative? How could the Base token impact Coinbase's stock? And does Base even need a token? In this video, we'll give you all of the answers, including how all of this came about, how to position yourself for a Base airdrop, some potential issues, and which one will be best: Coinbase stock, the Base token, or both. My name is Lewis, and you're watching the Coin Bureau. First up though, I am not a financial advisor, and nothing in this video is financial advice. This is educational content meant to inform you about the upcoming Base token. If that sounds good to you, then smash that like button and drop a comment to let us know that you're excited about the airdrop. Now, when Coinbase rolled out the Base Layer 2 back in early of 2023, it stated that, quote, we have no plans to issue a new network token. Fast forward to the Basecamp conference in mid-September this year, and things started to change. During a presentation, Base creator Jesse Pollock announced that the Base team was beginning to explore a network token. This was later reiterated on the official Base blog. That's big news, but Pollock stressed that there are no definite plans on timing or design, and that any exploration will be done out in the open. Still, it's very different from the we don't need a token, and it came with 3 other commitments: stick with Ethereum, work with US regulators, and bring the community along for the ride. For context, the Basecamp conference had other significant announcements that happened to fit hand in glove with a Base token launch. These include an open source bridge between Base and Solana and another round of Base batches for builders, which are more incentives to build out the ecosystem. But why explore a token now? Well, the stated rationale is to accelerate decentralization and broaden participation, especially for builders and creators, as the network matures. The announcement paired that theme with the interoperability push via the Solana bridge. That might sound strange, giving a shout out to what is technically a competing chain, but it was basically a signal that Base sees a wider, more connected surface area as part of its endgame. Again, no token mechanics yet, but the language is clear: crypto community alignment first, compliance always, and token details later. To be fair though, Coinbase's original stance on a Base token back in 2023 probably wasn't a bluff. At that time, the regulatory landscape for crypto was much worse than it is today. Also, Base likely wanted to prove that it could facilitate sub-second, sub-cent transactions and ship apps without the hassle of a token. But with those boxes checked, the door's now open to consider a token as another tool for growth. It's just not clear how they're going to use it. That's the needle that they're signaling that they want to thread, and why the phrasing remains careful. However, after making an announcement like that, it's almost certainly more a question of when, not if. But will the Base token fly or flop at launch? The answer is actually pretty easy to figure out when you look at the fundamentals of the Base Layer 2. Let's start with the main metric that everyone looks at: total value locked, or TVL. Base's TVL chart has been up only as capital has flooded in over the last couple of years, with TVL recently pushing through the $5 billion mark according to DeFi Llama. Revenue is another key metric, and sure enough, things look good here also. Throughout 2025, Base has been seeing roughly $5 to $6 million in revenue each month. That's capital that could theoretically be used to buy back the Base token at a later date. There's also raw user activity. Believe it or not, but Base currently ranks number 1 by daily average user operations per second among Layer 2s. So people aren't just parking assets there, they're actually active on the network. The amount of stablecoins on Base also provides some additional insight here. Base carries roughly $4.4 billion worth of stablecoins, 90% of which are USDC. Logically, a big stablecoin supply greatly facilitates on-chain activity like lending, swapping, and other DeFi activity that keeps on-chain economies busy and growing. And this actually ties into a critical trend in crypto, which is that on-chain trading has been eating into centralized exchange dominance this year. DEX market share hit fresh highs in Q2, which tracks with Base's own soaring activity. When more trading happens on-chain, networks with low fees and lots of useful apps soak up the activity, and Base is ahead of the curve thanks to its Coinbase integrations and the recently launched Base app. Put all of this together and you've got a network with serious cash flow, active users, real liquidity sitting in the pipes, and a clear plan for expansion. Whether or not a token is strictly needed, that's debatable. But if it comes, it looks like it would fly rather than flop. And if you want to make sure that you're ready for when it launches, then you have to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and deposit cashbacks of up to 75% on the best crypto exchanges. To get all these goodies, all you need to do is just hit the link in the description or scan this QR code. Once you get on the deals page, just find a deal that suits you and click one of the sign up now buttons. Now remember, these deals, they won't be around forever, so take advantage of them while you still can using the link in the description below or the QR code on the screen. Okay, so with all of that Base bullishness, you're probably asking, how can I get a piece of this airdrop? Well, there's no official guide, at least at the time of the shooting. To refresh your memory, the team has only said that they're exploring a token and that they've kept it deliberately high level. No timelines, no mechanics, no distribution promises. So, how do you position yourself given the lack of information? Well, it's actually pretty easy. You look at what's been done with previous Layer 2 token airdrops and focus on the kinds of actions that signal that you're a real user and not a points farmer. Arbitrum, another leading Layer 2, is one example. It used a point system tied to meaningful on-chain activity and time on the network, and it added an anti-Sybil filters to weed out mass-farmed wallets, at least as much as they could. Optimism is another example. It assessed airdrop eligibility using multiple rounds of incentives, explicitly rewarding constructive participation such as governance, builders, and app users via its airdrop and retro funding program. The obvious lesson from these examples is that depth and consistency of use beats blasting 100 tiny swaps or transactions in one day. The latter also happens to be exactly the kind of pattern that gets flagged in postmortems on airdrop Sybil attacks. Now, if you're wondering how your on-chain activity stacks up in this sense, there's actually a website called On-Chain Score that offers some insights into how your wallet activity on Base is perceived. And it just so happens that it was launched by Coinbase CEO Brian Armstrong. Totally a coincidence, right? Anyways, On-Chain Score provides you with a wallet-level reputation snapshot based on your on-chain activity. The site gives your wallet a score out of 100, which reflects your so-called on-chain nativeness, with Armstrong himself posting that he scored an 83 soon after the site launched. So, with a Base token launch in mind here, let's have a look at some steps that we could take to increase our score and improve our odds of getting a sizable piece of a Base airdrop. First off, consistency is key. Spread activity across weeks, not hours, so that your history looks organic rather than that of an airdrop hunter. Diversity comes next. You could mix swaps with basic DeFi actions like providing liquidity or lending on protocols like Aave, and try this in small amounts that you could repeat so that your address shows more than one-click behavior. Identity is a massively underrated angle as well. One thing that you could do here is register a Base name so that your wallet address has a name and profile that other apps could read, instead of, the usual string of unintelligible characters. Balances within your wallet also matter because they show intent. If you hold some stablecoins and a small chunk of wrapped BTC on Base, it looks a lot more like you're here to use the ecosystem rather than just ticking some airdrop hunting boxes. The Coinbase version of wrapped BTC, CBBTC, is live across Base and Ethereum for exactly this purpose. And if you're a builder or creator, even better. A single contract deployment on Base, a tiny app-level experiment, or being a creator in Base-based social apps like Farcaster will likely boost your odds of an airdrop. There's also Base's upcoming Web3 super app, currently waitlist only, but you could find a link to join that waitlist in the description. Now, just a quick reality check before anyone starts YOLOing in gas fees. While a Base token airdrop is almost certainly in development, the potential value of it is anyone's guess. Also, geography may well affect eligibility, and Coinbase's entire image is built around compliance. Don't mean to rain on anyone's parade, but I'm just stating the facts here. Now, we've only looked at a few key factors to consider for a potential Base token airdrop in this video. If you'd like a comprehensive playbook covering the specific actions to take and how much weight each carries, you'll find a link to a full outline in the description down below. With all of this hype for the token brewing, there's one question that has yet to be answered. What will the base token actually be used for? Well, the clearest clue is the team's own framing. A token is being explored to push decentralization and broaden participation. Along with that, there's a commitment to work with regulators to keep things compliant. That sets the tone for utility that serves the network rather than a quick cash grab. For reference, base users pay an ETH for gas fees when executing transactions, as with most Ethereum Layer 2s. That was true before other Layer 2s had a token, and it was true after their tokens were launched. So don't expect Base to be a gas coin. Swapping ETH for a new fuel type would break a lot of UX and composability that already works. So what actually makes sense? Most likely, governance. That includes voting on network parameters, treasury programs, and public good grants. Again, similar to other Layer 2s. That model is battle-tested and easy for users and builders to plug into without changing how they transact. The caveat is something that I mentioned earlier, and that's the potential for base token buybacks. On one hand, Coinbase may not be keen to share that fee revenue with base token holders. On the other hand, though, Coinbase already does buybacks of its own stock using revenue. So it's not out of the question that we'd see a similar mechanism introduced for the base token. And there's one last thing to note. Base is part of the OP Stack superchain, which means that it sends a small cut of its fees back to the Optimism Collective, the greater of 2.5% of its revenue or 15% of profit. So, any base token buybacks would need to work alongside that setup. In practice, that makes governance tools even more likely than a yield token boosted by Base's revenue. Now, with all of that in mind, it's time to address that elephant in the room: Coinbase's base token versus Coinbase's stock. The launch of a base token could possibly see a tug-of-war between that token and Coinbase shares. So, which is likely to come out on top? First, let's be clear on what each thing actually represents. Coin shares are straightforward. Regulated equity in Coinbase Global Inc., the publicly listed crypto exchange that earns from trading, custody, stablecoin economics, subscriptions, and yes, its on-chain initiatives like Base. To put things into perspective, Base's network operations contribute to Coinbase's reported results. The company has explicitly called out other transaction revenue being driven by Base in shareholder materials, evidence that this flow currently belongs to Coin shares. If a Base token later siphoned any of that value, Wall Street would read this as a value leakage from shareholders to token holders. A Base token, if it exists, is therefore more likely to be governance and incentives focused rather than include any cash flow rights. That's simply because anything more could negatively impact the coin stock. A governance-first focus is also the norm for other Layer 2s, as we discussed. Control is another closely related issue here. If Base token holders steer parameters, fee switches, and treasury allocations via governance, that's control migrating further away from corporate HQ to a token electorate. That might be good for decentralization, but public market investors could see it as dilution of strategic control over assets incubated inside of the company. And if you want a real-world precedent for how companies try to keep equity and tokens from stepping on each other's toes, look no further than OKX. Before becoming more vocal about their ambitions for an IPO, the exchange went out of its way to separate its exchange token, OKB, from the business operations or economics at the exchange level. So, tidying tokenomics and maintaining a separation between the listed entity's financials and the token's value is the sort of thing that reassures shareholders. And it's likely the same principle coin shareholders will look for if a Base token does appear. But now for the big question. Which is the better investment? If you want broad, regulated exposure to Coinbase's full stack, retail and institutional trading, custody, stablecoin revenue shares, infrastructure, and the optionality of on-chain products, Coin is the instrument for that. Index inclusion in the S&P 500 also adds a structural bid from funds that must own the benchmark. But if you want on-chain participation with the Coinbase community, the Base token would be your lever. With all of that said, though, it is worth reiterating that the team has yet to unveil concrete details on the token and its tokenomics. Just because other similar projects have followed a certain playbook doesn't mean the Base team would do the same. They may have some clever innovations up their sleeve. Nevertheless, framing it as we have, the answer is pretty clear. Coin is likely a better investment than the Base token, at least over the long term. But this is crypto, and a fresh hyped up token does not need much reason to run over a relatively short period of time. So don't be rushing to short it either. But we want to know what you think. Would you prefer to hold a Base token or Coinbase shares? Or do you think that holding both is a good idea? Let us know in the comments below. And if you want to learn about the billionaire betting big on the Ethereum ecosystem, then you could watch our video on that right over here. As always, thank you so much for watching. I'll see you again very soon. This is Lewis, over and out.